Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from US tax regulations to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of PwC Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're back in Washington, D.C. in PwC's Policy on Demand studio, where I'm excited to have Laura Williams on the podcast. Laura is an international tax principal in PwC's Washington National Tax Services practice. Before joining PwC, Laura spent almost 4 years as the international branch chief at the IRS's Office of Chief Counsel. Laura, welcome to the podcast.
Thank you, Doug. It's good to be here.
It's great to finally have you on. So before we dive into what is some immensely complex regulations, I noted doing some background research that you have an undergraduate degree and master's in accounting from the University of Tennessee, who I'll note has been beating up on my Missouri Tigers in both football and basketball over the last few years in the SEC. But we don't need to turn this into a sports podcast. But you interestingly started your career as an auditor, and then after 3 years, you decided to go to law school, where you then moved into tax. Maybe what led to that decision, and why international tax?
Yeah, well, law school was always something that was on my radar when I was young and in undergrad. And so that was there. And then, believe it or not, I was not the most amazing auditor. I loved some of the complex issues that companies were facing, but auditing wasn't exactly for me. So made a change, went to law school, and then found that tax, especially international tax, was a great way to combine my background in accounting, my CPA, with the law.
Yeah, I think it's a very interesting point. And I had a very linear career. I mean, I went straight from undergrad to law school and then straight into international tax. So I haven't really known anything different. But I think for a lot of most students and then also young professionals, that there's a whole number of things that you can do sort of in the accounting and the tax law field. And there are sort of different skill sets and a mindset between auditing and tax and frankly other areas. And I always encourage people, whether they're a student or earlier in their career, that if something may not be a right fit, there are other things out there. And I think you're a great example of that.
Yeah.
All right, so let's move into the technical material now. And what we're going to be talking about today is previously taxed earnings and profits, or what we'll be referring to as PTEP. And this, before the Tax Cuts and Jobs Act, used to be known as previously taxed income, but I'm still like, if I may slip up at some point where and call this PTI, just dating myself. But what is PTEP?
Sure. I mean, as you mentioned, previously taxed earnings and profits. And what it's referring to are the earnings and profits of a controlled foreign corporation, or a CFC, that have been subject to current taxation at the US shareholder level. So most commonly, it's referred to as Subpart F income, or what we now have as GILTI income under TCJA. So once those earnings are included in income of the US shareholder, they become referred to as PTEP because the EMP is still at the foreign corporate level.
And the reason that we need that we have these rules is because this previously taxed earnings and profits, this PTEP that sits at the CFC, there may be a number of years or difference in time when that earnings that has already been subject to US tax, when that's actually distributed back to the US. And so we're going to talk about some concepts, and we're going to use some code sections, and we're going to try to define them. But for example, 986C is a provision that applies for foreign exchange gain or loss, as an example. So when a US shareholder has earnings that have already been subject historically to US tax in year one, and then a few years later they make the distribution, well, the foreign exchange rates could differ from what the local currency is of that CFC versus what the US dollar amount is, what the time that it's earned and when the time that it's distributed. So there are very prescriptive rules on recognizing that gain or loss. Similarly, to the extent that it impacts basis that we'll talk about, like in a subsequent year when maybe that CFC has moved around or been sold. So there's some very complex rules that we're going to go through. But for any US parented group or a US holding company, for example, and you've got CFCs, that the taxpayers need to understand when those income that has already been subject to tax, when it comes back, it could still actually be subject to more tax depending on what has happened in the meantime, whether it's with FX rates or with basis. And that's really the purpose of those rules.
Yeah, I had a colleague at the IRS who explained it to me one time as it's like a repatriation or a deemed repatriation of the earnings, and as if the shareholder had contributed that back into the CFC. And that's why you have the corresponding basis adjustments, and you have to track that FX movement, is because eventually you're going to see that, return on that contribution.
And that my mentor, who taught me a lot about international tax early in my career, explained it the same way. And I think it's worth restating, so that when the U.S. shareholder has a CFC and they have earnings that are previously subject to tax, what the rules generally require is that U.S. shareholder increases their basis, for example, by that underlying income that had been previously subject to tax. Reason for that is that if that U.S. shareholder, for example, would sell the CFC, well, they've already been subject to that tax. It should increase the basis and otherwise reduce the gain that they would have. Another really good kind of policy reason, particularly for some of our non-U.S. listeners, to understand why we have this immensely complicated set of rules.
Yes.
So how long, Laura, has the U.S. Treasury and this is a loaded question, I'm going to warn you. How long has the U.S. Treasury and the IRS been working on this package, and why has it taken so long for us to finally get these rules?
Sure. Yeah. So right after TCJA was enacted, right, which was the end of 2017, Treasury and the IRS got busy on issuing as much guidance as was possible. There were huge changes in the international space, as you know. And so PTEP was high on the priority list, probably not the highest, right? And so Treasury and IRS were able to get out a notice at the end of 2018, which provided some fundamentals on PTEP, right? The accounts and some basic basis, and as you mentioned, the 986C, the FX, gain or loss rules. They got that out, and then they started working on the regulations. So it's been 7 years, I guess, 7 years now. And, in their defense, there were a lot of competing priorities. There was a pandemic. There was an administration change. And when administrations change, new people come in who have different points of view, perhaps. Also, there was a focus of the administration on some other things, right? Pillar 2 was a big priority. And then Build Back Better, which turned into the Inflation Reduction Act. So all of these things, I think, and I know, slowed down the process. But yeah, it's been quite a while, and I hope that the regulations are reflective of the time that went into them. They are very dense and very complex, but I think they're very accurate and very well received, at least by me.
Yeah, I've also read, Laura, that we've recently had an administration change here in the U.S. So we're going to come back to that and later in the podcast to talk about what does this recent administration change potentially mean with this reg package. But you'll have to stay tuned for that. All right, so let's get into the reg package itself. And before we dive into the specifics, what are a few key things taxpayers should be made aware of from this reg package?
Sure. So applicability dates we'll talk about at some point later on, but those are important. There's some nuances there for people to be aware of. Basis consequences. So there are a lot of rules in the 961 regulations that provide timing for basis. There's also a negative basis concept that we'll get into. So important for people to be aware of those. And then, of course, the account maintenance. So there are 10 different groups of PTEP. There are dollar basis pools, foreign tax credit pools. So a lot for taxpayers to be tracking and keeping up with.
Yeah, and this tracking point of and we're going to dive into some of these specifics. I think that, particularly for my travels and my role and meeting with a lot of non-U.S. parented groups, that U.S. taxpayers, I don't want to say have just a better understanding or ability to be able to track massive amounts of data just because of the nature of our rules. And this has been a particular challenge for some non-U.S. and frankly for most taxpayers, like Pillar 2 as an example. And I think it's one of the reasons that maybe U.S. taxpayers are easier, or have maybe an easier time being able to try to comply or at least set up some of the basic infrastructure that is needed, because a lot of that infrastructure, or some of that infrastructure, or at least the process with PTEP and a number of the other attributes that US multinationals have to do is just not, we don't see that really outside the US. And I certainly don't mean to imply that Pillar 2 is easier for US shareholders. It's just, I think they may have a better appreciation for the complexity. All right, so let's dive into some of the specific sections of the proposed regs. And I want to start with the 959 regulations. And for those that don't know what section 959 is, that is the code provision that allows taxpayers to effectively exclude previously taxed earnings and profits, PTEP, from US taxation when those earnings come back. And I think the first real big piece of the regulations was this point that you had just mentioned, PTEP accounting. So talk a little bit about that.
Sure. So taxpayers are now required to track annual PTEP accounts, annual dollar basis pools, and annual PTEP tax pools. And so we'll start with the PTEP accounts. So there are 10 PTEP accounts. It started in the notice with 16. They were able to bring that down to 10. And they
After some comments, I assume, from taxpayers.
Yeah, and I think a realization that there were some that were duplicative in the purpose, and you didn't need to track different types of PTEP that all resulted in 245 Cap A, for example. So annual PTEP accounts, the reason for doing it annually is there is a LIFO approach, so last in, first out with PTEP distributions. Dollar basis pools, those pools are just tracking your FX gain or loss, right? So you track it, and then when you have a distribution or some other PTEP realization event, that gets recognized by the US shareholder. And then the tax pools, which primarily you're talking about Section 960B, which would be like withholding taxes or taxes imposed on movements of PTEP. And so that's being tracked so that at the appropriate time, US shareholders can take credits for those. So those are the three main groups of accounts. They're done by shareholder level. And I think that's an interesting point for people to be aware of, is that traditionally we maybe thought about PTEP as being more of a CFC level, foreign corporation level attribute. The theme that you see through these regulations is that Treasury and the IRS are kind of leaning into this concept that these accounts are really shareholder specific, that these attributes are shareholder specific and should therefore be attached to the shareholder who had the event that led to the PTEP.
So will we see, is there a potential that the compliance for this can change? Because I think historically, the returns that are filed with respect to a CFC, which is a Form 5471, that's where those PTEP accounts, that's where those were typically tracked, or at least when a taxpayer would file. I wonder if that will continue to be the case, given that it's a shareholder level attribute, to your point.
I think it's probably the best way to align the shareholders' attributes with the foreign corporation. Otherwise, you'd have these huge, U.S. shareholder level amounts.
I don't mean to add any suggestions for additional compliance.
Please don't make the compliance any more complicated.
No.
But yeah, no, it's a good point. I mean, you still track it at the CFC level. It's just there seems to be this kind of leaning into it's a shareholder attribute.
Okay. And then what about, there were some specific rules in this section related to distributions of PTEP?
Correct. So distributions of PTEP will cause a basis reduction, which we'll get into when we talk about 961. Obviously, when you are distributing PTEP and it goes up to the US shareholder level, you would be reducing your PTEP accounts to reflect that. I think the main takeaway on distributions, though, is that they are done on an aggregate basis, meaning if I am a US shareholder and I had an inclusion on, let's say, one share of stock, and then I later, make a contribution that gives me a second share of stock, a PTEP distribution can come out on any stock. It doesn't have to be the stock on which the US shareholder had their inclusion. And so when we get to basis, you'll see how that can create some problems, because now PTEP can come out on any shares, but basis may not always align.
Yeah, and this is a common issue, not just in the kind of the PTEP realm for US taxpayers and what we often refer to as blocks of stock. And then there's the famous case, the Johnson case. We sometimes refer to this as a Johnson issue, whereas a US shareholder, frankly, any shareholder that has stock in a US corporation or a CFC, if they've invested money in different time and whether they got shares back, you can have these things called blocks of stock. And how those PTEP rules kind of fit within that can certainly be complicated.
Yeah, and it came up on a recent, at a conference recently, and the government was asked about this. Why did you, kind of follow the sub-C principles that would allow for this Johnson problem to exist? And what they said was interesting is they felt like they had to follow the sub-C principles, that PTEP really kind of followed sub-C and the basis rules that exist within the sub-C space. So I thought that was interesting.
Yeah, I actually find that encouraging. So,
yeah.
All right, so what about allocating and apportioning taxes, and specifically current year taxes, and we can talk about Section 78.
Yeah, so there are rules within the regulations that tell taxpayers, with respect to 861-20, for example, like that on how to allocate foreign tax credits to the tax pools based on the type of income that gave rise to the PTEP.
So to help sort of allocate where those taxes go across those 10 different, those different accounts.
Correct, yeah.
All right. And then what about general successor transactions? What does that mean, and what do those rules generally say?
Right, so when you have shares of stock where there's PTEP that's attributable to those shares and belongs to a US shareholder, and that stock is transferred, for example, in a sale to another US person, these rules tell you that the PTEP transfers along with the stock. And that's helpful because based on the statute in 959, successors to PTEP, it has to be to the satisfaction of the secretary or the commissioner. And when I was at the IRS, we would have taxpayers come in and ask for rulings or closing agreements that they were successors to PTEP. So these rules streamline that for taxpayers, so you don't have to go in and ask the IRS to confirm that you as a buyer of stock are a successor to that PTEP.
And does that apply, well, historically, I guess, for both third-party transactions, or what about like internal transactions where companies may be integrating, for example, a recent target?
Yeah, so what you'll see is there are, and we'll talk about the consolidated return rules that treat members of a consolidated group as having one PTEP account. So it's not going to come up so much in restructurings as it is when it's going on between, transfers are happening between unrelated parties.
Another teaser for later in the podcast.
I know.
But they have simplified that analysis by treating the U.S. group as one shareholder, which we'll come to.
And for your foreign parented listeners, this is an interesting rule that's in the general successor rules, which is that if you have a foreign buyer of a CFC that has PTEP, they are deemed to be a covered shareholder for that period of time. So if that foreign target ever comes back into the U.S. tax net, you have to recreate, the rules tell you to recreate the PTEP accounts with respect to that entity while it was fully foreign owned. And I think that's been very surprising to people.
That will be challenging to track for those
Yeah.
foreign parented groups.
Yes.
And we'll add that to the list of things that those foreign parented groups need to track. All right, so let's move on to the Section 961 regulations. And Section 961 is the provision in the U.S. Internal Revenue Code that details what basis adjustments are required. So the way you explained it earlier, when you have that inclusion at the CFC level, whether it's subpart F, whether it's guilty, whether it was the toll charge as a result of the TCJA, there are specific rules with respect to how is that basis determined and what adjustments need to be made to that basis. So maybe start with this concept that they talk about, which is property units and basis.
Sure. So property units can be one of two things. It's really stock, right, or a partnership interest. And as you mentioned, when there's an inclusion by a U.S. shareholder, right, they make a basis adjustment, an upward basis adjustment under Section 961A. So that upward basis adjustment is being made to these property units. There are also 961C basis and derived basis. This derived basis concept is introduced as part of the proposed regulations.
And 961C, just to interrupt, is like the lower tier basis. So if you have a US shareholder that owns a CFC that then has another CFC, that's what 961C sort of deals with.
That's right. 961C was added to the code in 1997, so subsequent to the other rules on basis in the same code section, and applies between CFCs and is a limited purpose basis. So it only applies for purposes of determining the US shareholder, who's at the top of the structure, determining their subpart F inclusion.
All right, so sticking with 961, basis reductions and gain recognition for certain distributions, and they kind of break this into three groups: U.S. shareholders, partnerships, and CFCs. So maybe let's start with U.S. shareholders, and at a high level, what should taxpayers be aware?
Sure. So when a CFC makes a distribution directly to a U.S. shareholder, there's a downward basis adjustment that has to occur. It can be basis that was created because of the inclusion, or it could be basis that was created by any purpose. It's any adjusted basis when it's a direct distribution to a U.S. shareholder. If there is not sufficient basis to support that PTEP distribution, then there is a recognition of gain as if the stock was sold. And so it can give rise to capital gain, also could give rise to a 1248 recharacterization of capital gain, which for people who may not be familiar, 1248 is a recharacterization of gain to a dividend. So that's 961A basis. It's like adjusted basis.
And then what about, and this was a question that many of us have struggled with for years, what about with respect to partnerships?
Sure. So partnerships are, U.S. shareholder has an interest in a partnership, and many of us believed that when you have an inclusion, right, and we had regulations after TCJA that told us that we treat domestic partnerships as aggregates for purposes of subpart F and GILTI.
So where a U.S. shareholder owns a partnership that owns a CFC, there are special partnership rules that determine basis that kind of sit outside this, and squaring up all of these rules was always a challenge.
Correct. And so now we know U.S. shareholders, they are able to increase their basis in the partnership interest under 961A, as I was describing before. It's just like adjusted basis. But the big open question was, well, does the partnership have basis in the CFC stock? Because the CFC is the one that has the PTEP and is going to be making a distribution. And you need basis in the CFC stock to avoid any sort of recognition of gain, the capital gain I was describing before. And so these regulations give us derived basis, which is limited purpose basis, very much like 961C basis, the lower tier CFC to CFC basis. So distributions from a CFC to a partnership will result in a downward adjustment of derived basis. There is a concept of going into the negative on derived basis that is in the regulations. So if a partnership did not have sufficient derived basis, but they had real adjusted basis in the stock of the foreign corporation.
And so what they actually paid for it or what they've invested.
Exactly. They would be able to go into the negative on the derived basis to the extent they have real basis, real adjusted basis. And at some point in the future, though, the IRS is going to come to collect on that. So if there was a sale or other realization event with respect to that basis, it would trigger gain at that point in time. So.
Yeah, just whenever I hear the words negative and basis combined, it's always a little hard for me as a U.S. tax practitioner to wrap my head around, but certainly understand sort of the policy reasons for why they've structured it as they did. And maybe lastly in this section, what about CFCs?
Yes, so CFC to CFC distributions will reduce 961C basis. Again, if you don't have sufficient C basis, you can go into the negative to the extent of your real basis. I think what's surprising to taxpayers with respect to this rule is that a distribution of PTEP out of a CFC to another CFC can cause the recognition of gain at all. Many people were of the view that a lower tier PTEP distribution could never give rise to gain and it only in circumstances where you had a sale of that lower tier CFC stock. So this makes clear, no, you can have the recognition of gain if you don't have sufficient 961C basis. And I'll just point out, that is the IRS's position of the current law today. So even though proposed regs, those are going to be prospective, it's good for taxpayers to be aware that the IRS is challenging the position and believes that this is the best interpretation of the statute today.
So moving on, we'll stick with basis adjustments. There are some specific rules with respect to basis adjustments for foreign currency gains or losses. So this 986C concept that we introduced.
Sure, and I mean, that's going to be tracked in your dollar basis pools, right? And so when there's a distribution of PTEP, when there's a sale of the CFC stock, that's when you would have the recognition of that foreign exchange gain or loss.
Yeah, so the takeaway that I have from this particular area is that if a taxpayer is doing a transaction where basis is relevant, and typically that's going to be a sale, like you have to navigate through these rules and then go back, and there's some historical analysis depending on how diligent taxpayers have been with respect to keeping their PTEP pools kind of in there on those 5471s that I mentioned. Like, there's certainly some homework that taxpayers need to do anytime they're doing a transaction. And now this is really relevant for any CFC, right? Because post the Tax Cuts and Jobs Act, where we now have GILTI, right? Almost every CFC that's worth something that has had some earnings and profits, a chunk of that is likely has already been subject to tax, which means you've got PTEP, and then you have to navigate these rules to really understand what that basis impact is, to determine what the gain is, and make sure that you're not tripping over something that you may not be expecting. All right, so we're going to move on from 961 and then go on to section 951. So one of the things that is mentioned in the 951 regulations is it talks about the assignment and allocation of covered items of a foreign corporation. Talk a little bit about that.
Sure. Yeah, so when a CFC receives a distribution of PTEP, or there's gain that's attributable to the sale of a lower tier CFC, and there's 961C basis that's used, the new regulations will require taxpayers to kind of trace those items to the US shareholder that had the attribute to begin with. This is going back to my point about the theme that these attributes are really belong to US shareholders. And so you have this modification to the way that income is allocated to different shareholders. So they could be US shareholder and a foreign shareholder, or a different unrelated US shareholder. And the reason for that is to make sure that the US shareholder who had the inclusion that gave rise to the PTEP, that they're given credit for that PTEP when it is distributed to another CFC. And so that they won't have too much subpart F income. And also to ensure that the other shareholder, who could be foreign, could be another US person who didn't have the inclusion, that they don't benefit unnecessarily or inappropriately from that PTEP. It also ensures that expenses get allocated and that foreign tax credits get allocated appropriately to the shareholder who really, had that inclusion in a previous year.
So in those proposed regs, they also mention some concepts called covered distributions and covered gains. Any important things that we should be mindful of in those areas?
The covered distribution is just really a definition of a dividend. It can include a deemed dividend, excluding certain types of deemed dividends. So there are Section 78 gross ups. That's where taxpayers have to increase their income by a dividend amount to reflect foreign taxes that have been paid at the foreign corporate level.
And the reason for that is, and this is another, my mentor explained that, well, if you didn't have the Section 78 gross up to include those taxes, effectively taxpayers would get both a credit and a deduction. So the idea is, well, if you get a credit, you have to gross up under, it's why I refer to it as the Section 78 gross up, to sort of make sure everybody's whole.
Right. And so that's excluded from the definition of a covered distribution, because if it wasn't, then you could claim that that inclusion is a PTEP, distribution, and should be exempt or excluded from gross income. So really it's just starting with a dividend and then applying the PTEP accounts to determine how much of that distribution should be recharacterized as PTEP. covered gain is just gain recognized from the sale of a CFC where there was PTEP, and that gain's being reduced by the basis, the 961C basis at the CFC level.
All right, so moving on to Section 986C, which we already introduced as the provision that requires taxpayers to recognize foreign exchange gain or loss from the time the income was recognized and the time that it was distributed. And I will note that that is generally ordinary income when recognized by the taxpayer, any foreign exchange gain or loss. What do these regs tell us, or what should, there's quite a bit that tell us, but what are some of the highlights or things that listeners should be aware of with respect to the 986C regulations?
Yeah, just that you will be tracking them year over year in dollar basis. There is an election in the regulations to combine and so pool your dollar basis accounts into one. Same for foreign tax credits. So taxpayers can make that election. It's supposed to provide some administrative relief for taxpayers. But once you make that election, you are stuck with that election. So it's good to be thoughtful. It has to be applied consistently. But yeah, 986C can give rise to gain or losses and will be triggered on distributions or dispositions of the stock.
All right. So one of the other provisions that we're not going to get into which is Section 960, which generally deals with deemed paid credits for subpart F inclusions. A lot of that, in my view, is more coordination type provisions with some of the pieces that you've already described. I do want to come back to, and we mentioned this earlier, which is, I think, a new concept related to Section 1502 and those rules. And what those rules generally cover are the consolidated return rules for U.S. groups. And you'd already teased us earlier with the U.S. group is treated as a single covered shareholder. Maybe spend a few minutes with that.
Sure. So this concept, like you mentioned, every member of the U.S. consolidated group is treated as having a single PTEP account. And so therefore, when you're doing restructurings, right, a different U.S. shareholder, and it's a little contrary to the way that we think about these inclusions, right? Because subpart F guilty, or at least the tested income, right, that comes up to one U.S. shareholder. Right. They have the inclusion, and so you would think they have the PTEP account. Another member of the consolidated group who did not have that inclusion wouldn't have a PTEP account. Well, this says no, treat them all as having one account, and so you can move controlled foreign corporations throughout your group while maintaining, your PTEP. However, where this can be problematic, or it kind of exacerbates the Johnson problem that you were talking about earlier, in that now a distribution can be PTEP on any share of stock, and it can be to any member of the U.S. consolidated group, but you may not have basis because basis adjustments are done on a share-by-share basis under these regulations. Yeah,
that is certainly a trap for the unwary and something for taxpayers to be mindful of.
I will add one thing with the consolidated group rules. They can share 961C basis. So I think that is surprising to people as well.
The lower tier basis.
That's right. The lower tier basis can be shared, but not the upper tier basis.
Okay. So there are a number of other miscellaneous provisions. We certainly don't have time, but there's provisions with respect to S-corps, provisions with respect to Section 962 elections, so that's U.S. individuals electing to be taxed as corporations, some currency translation rules and functional currency rules. We have an alert that we'll include as part of the show notes to this for folks that want to dive a little bit deeper into any of these rules. But the one other provision that I wanted to mention, get your thoughts on, are the anti-avoidance rules. How did the Treasury and the IRS approach that for these provisions?
Yeah, so the anti-avoidance rule is a principal purpose test. So if you have a series of transactions, arrangements with the principal purpose of avoiding the purposes of 959 or 961.
That's almost a direct quote, I think, a principal purpose to avoid the purpose. I love it.
So taxpayers are put in a position to determine what are the purposes of 959 and 961, and am I avoiding them, or do I have a principal purpose of avoiding them? It's become pretty standard for Treasury and the IRS to include these anti-avoidance rules. They have a chilling effect. And, Treasury and IRS, they don't know what they don't know. And so that's really, the function of the rule. I know that they're very concerned about basis shifting, right? And there's so much basis in the system now as a result of the inclusions of subpart F and guilty. And so I think that's where the focus of the IRS has been primarily in trying to, prevent taxpayers from inappropriately benefiting from basis.
Yeah, I think the challenge for taxpayers, and I certainly understand the point and what they're trying to avoid, but the broader the rule that they make for these anti-avoidance, there's a lot of taxpayers and advisors that have questions about, well, could that potentially could a transaction that really wasn't intended to to purposely avoid the purpose? It's a broad standard that I think makes it challenging for taxpayers, and I think that's one of the reasons in particular we see some comments on more targeted type of anti-abuse rules than these general rules, because it creates a lot of uncertainty for taxpayers.
And it's hard for the IRS to enforce as well. Right?
Sure.
And sometimes you'll see these rebuttable presumptions or per se components to anti-avoidance rules, which doesn't exist here, but as a way to help the IRS actually enforce.
Okay, so I do just want to mention, I've got a list here of a number of things that are not covered. We're not going to get into what's not covered, but I think for listeners, what it's not covered: reorganizations, inbound non-recognition transactions, redemptions, stock sales by CFCs, structures where CFCs that are partners in a partnership, we already mentioned that, PFICs, application of stock sales to partnerships, you had mentioned that, rules regarding the transfer of PTEP and acquisition that are not considered general successor transactions. So still a number of unanswered questions. And to your point, I certainly have sympathy for Treasury and the IRS. These are complicated stuff and only so much time, and we'll see what additional changes. But maybe as we wrap up, because this is also a very interesting point that you mentioned earlier, the effective dates for this. Talk a little bit about that.
So these regulations will not be effective until they're finalized. And once they're finalized, they will apply to foreign corporations' tax years, so your CFC's tax years, beginning on or after the date of the finalization. There's an exception for the rules that were provided in the notice that I mentioned earlier on. It's 2019-1 that gives us all of the PTEP accounts. Those rules will be effective for tax years of the US shareholder, interestingly enough, that begin on or after December 14th of 2018. And then the most interesting point is this early adoption point. So the regs provide that taxpayers can early adopt these regulations. They can apply them to all open years. However, it's as finalized. And there's no reliance language in the regulations. And so if you want to early adopt, and so this is incredibly important for taxpayers like private equity funds who have partnerships and they're going to be relying on that derived basis rule, you have to wait. You can't rely on them now. You have to wait till they're finalized. Then you can go back into your open years, either by amending or filing your return consistent with the final rules. And so that's created a lot of confusion, understandably, because it says you can early adopt, but without the reliance language,
I
you have
would
to wait.
both speculate and encourage that we will hear a number of comments related to that, because just the administrability, particularly to your point for those in the private equity industry where partnerships are just how they do business, will create some consternation. Maybe finally here, I will note that the comments are due for this by March 3rd, 2025. And as we hear a lot, as I mentioned on the cross-border tax talks, like taxpayers should absolutely comment on this. And maybe if you could even, like when you were at the IRS and working with Treasury, the question, do they actually listen to the comments?
Yeah, they really do. And especially with a package like this that's so complex, right? And there was a lot of pressure to get the regulations out in proposed form. They request specific comments, and then there's general requests for comments. I do believe they really are looking for taxpayers to comment and say, and provide suggestions on ways that these rules can be improved and refined to, be administrable and helpful for taxpayers.
So maybe last question here. This is a doozy for you. So these rules were proposed by the Biden administration, and to remind folks, both the Treasury Department, the IRS, sit within the executive branch, so part of the Biden administration when these were proposed. We now have a new administration that is in the White House. How does that new administration potentially impact this, particularly given that these are proposed rules?
It's hard to say, Doug. It really is.
It is.
It depends on the level of interest of the people coming in, right? And so, how many high up people at Treasury are going to care about the PTEP regulations? Some might. And so you may have people coming in with a point of view. During the last Trump administration, there was an initiative to pull back, a lot of regulations, especially those that were identified as being burdensome on taxpayers and, on just the population who's impacted by them. So we'll have to wait and see. It can slow things down, though, as far as the finalization, just because people will be, especially on the Treasury side, focused on getting the new administration up to speed and understanding what their priorities are. We have heard some comments that maybe the comment period, so March 3rd, as you mentioned, is when comments are due, that could slip because of the incoming administration. Don't quote me on that. That may or may not happen. But it can have an impact, but it's really hard to predict.
I would encourage taxpayers to still plan to get those comments in by March 3rd, 2025. Well, Laura, really enjoyed having you on. A very complex area. Fantastic job sort of trying to break this down. And we'll see what happens with this reg package, and if this thing gets finalized, and then however it gets finalized, we'll bring you back on and we can compare notes and see how everything shakes out.
Sounds good.
So thanks for tuning in to this week's episode of Cross Border Tax Talks. Thank you, Laura Williams, International Tax Principal in PwC's Washington National Tax Services practice. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.